Welcome to our proactive year-end tax planning ideas for 2020 workshop. I'm Paul Hutton, president of Hutton Wealth Management. One of my main goals as a comprehensive financial planner is to help my clients recognize tax reduction strategies and opportunities both within their investment portfolios and in their overall financial planning strategies. Staying current on the ever-changing tax environment is a key component to helping our clients benefit from potential tax reduction strategies. The objective of this workshop is to share some of those strategies that could be effective if considered and implemented before year's end. Please remember that this is a workshop and not a substitute for using a tax professional. In addition, many states do not follow the same rules and computations as federal income tax rules. Make sure that you check with your tax preparer to see what tax rates and rules apply for your specific state. The main theme for this workshop is to be proactive in our approach and in the tax planning instead of reactive, which can produce better results. Today's agenda is very straightforward. We're going to be reviewing year-end tax planning, and while doing so, we'll discuss some tax planning ideas and some strategies that you can consider. I believe in educating my clients on their choices, and our goal today is to give an overview of that tax planning so that when you look at your situation, you have some strong foundational information. Please remember, each taxpayer's situation should be looked at individually. The good news is that we're here to help you and talk with you about the specifics of your unique situation. I always find it important to review that there are 5 key areas to financial planning. We have preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today's presentation is going to be focusing on tax planning, which can also affect the estate planning component of it. As a comprehensive wealth management and financial advisor, we always try to take into consideration the impact of any recommendation that we make, not just in one of these areas, but in all of these areas. The tax planning for 2020 became a little bit more complicated because of the Secure Act, which was signed into law in December of 2019, and the 2020 CARES Act, which added some new laws and rules for taxpayers. Also, with this being a presidential and election year, it's helpful to consider some of the tax proposals that are being discussed so that you can plan and be informed. Let's talk quickly about the differences between tax planning and tax preparation. Tax planning is looking ahead before year's end, whereas tax preparation is filling out your tax forms after year's end. This workshop is about tax planning, not tax preparation. It's about hearing some proactive ideas that you can consider now to potentially reduce your taxes later on. One of the founding fathers, Benjamin Franklin, is credited with saying, "By failing to prepare, you are preparing to fail." For 2020, there are still 7 tax rates. There are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Under the current law, this 7-rate structure, which was created by the Tax Cut and Jobs Act, is scheduled to automatically phase out on January 1st, 2026. Here are the current tax rates for married filing jointly and single filers. Married filing jointly has lower rates on many amounts. For planning purposes, something you need to remember is that even if no changes were to be made to the tax rates in 2026, the law says we go back to the older and higher rates. Tax brackets are important, and current law calls for sunset in 2026, which means we go back to the older and higher rates automatically in 2026. When we think about your plan, please remember this. As this arrow shows, for some people, that means income that would be taxed at 24% today could be taxed in 2026 at 33%, a much higher rate. For 2020, the standard deduction amounts are $12,400 for an individual, $24,800 for a married couple filing jointly and surviving spouses, and $12,400 for married couples filing separately. And last, $18,650 for those filing head of household. So how should you view itemized deductions if you do not take the standard deduction? The old rule was to accelerate or realize deductions and take them as soon as possible. With the higher standard deduction, the new rule is to time or plan your deductions. Two of the more widespread deductions that taxpayers look at as they choose to itemize and not use the standard deductions are mortgage interest and state and local taxes, also known as SALT. Under the new rules for the mortgage taken out after October 13th, 1987 and before December 16th, 2017, mortgage interest is fully deductible up to the first $1 million of mortgage debt. That threshold has been lowered to the first $750,000 or $375,000 married filing separately on homes purchased after December 15th, 2017. For those of you with mortgages, please check with your tax preparer for how much of a deduction that you could take. The TCJA Act also limited state and local income, sales, and real and personal property taxes, the SALT tax we talked about earlier, to a maximum deduction of $10,000. One of the strategies for those taxpayers who like to give to charities is considered bunching charitable contributions. Here's an illustration of how that could work. If you're married filing jointly and had $10,000 of state and local taxes, which includes property and taxes, and $5,000 of mortgage interest, and give $10,000 to charity and no other itemized deduction, then you would have an itemized deduction of $25,000. The standard deduction for you is $24,400. So you would gain $600 by itemizing. In a 35% federal tax bracket that has an after-tax saving value to you of about $210. If you were to do that for 3 years, it would be worth $630 to you. An alternative strategy is to give $30,000 in 1 year and then use the standard deduction in years 2 and 3. And that would bring your deduction to $45,000 in year 1 and save you $7,210 over the standard deduction in year 1 at a 35% tax rate. By doing this, you would lose the additional $210 in tax savings from years 2 and 3, and you would receive that you received in the other scenario, but your total tax saving is $7,210 versus $610, which is $6,580 more than previously. Now you might be thinking, $30,000 is a lot to give in 1 year. So let's look at how a donor advised fund works. If you were to place $30,000 in a donor advised fund, you get the deduction immediately. And then you can give to charitable contribution as you see fit. If you have any questions on this or want to discuss this strategy, please give us a call. We'd be delighted to visit with you about that. Something that the CARES Act offered that's new for 2020 is the new charitable deduction available to taxpayers who do not itemize their deductions in 2020. This new benefit, known as the universal deduction, allows for an above the line or before you calculate your taxable income charitable deduction up to $300 per individual or $600 for married couples. To qualify, the charitable gift must be cash or cash equivalent made to a qualified charity such as a 501c3. This contribution must be made on or before December 31st of this year. As this draft 1040 form from the IRS website shows this deduction can be taken before you calculate your adjusted gross income. If you're itemizing or did last year, like to give to charities, please consider using this deduction and remind your tax preparer that you did that. Now let's talk about qualified charitable distributions, or what we call QCDs. This is a strategy for retirement savers. As part of the Secure Act, the required minimum distribution RMDs were changed to start at age 72 instead of age 70 and a half. Also, the CARES Act allowed you to skip or not take your RMD for 2020. Qualified charitable distributions are a tax law provision that allows retirement savers over the age of 70 and a half to directly distribute up to $100,000 to an eligible charity straight from the retirement accounts and not pay any taxes on that distribution. That's the big part. One idea that experts suggest is that if you're charitably inclined, consider using part or all of your required minimum distribution, your RMD, for qualified charitable distributions. Like many of the other strategies we're discussing today, this is one you should see us about if you're interested in evaluating your situation. We'd be happy to visit with you about that as well. Now let's talk about long-term capital gains. In 2020, long-term capital gains still receive a tax break. Here are the three tax breaks: 0, 15, and 20 for long-term capital gains. Pretty straightforward. One planning item that many taxpayers think about is tax gains and harvesting. So let's spend a little bit of time talking about that. Harvesting capital losses is a strategy that has been used for years. Taxpayers selling assets that are at a loss to offset capital gains. This reduces or eliminates a tax on current capital gains. On the surface, loss harvesting produces an economic benefit equal to the tax savings. However, sometimes it can only provide a timing benefit. This is a tax deferral strategy that could be pretty valuable to some people. Capital losses are highly tax effective if they can be used to offset income tax at higher rates. A key fact to remember is that you can use up to $3,000 in capital losses above capital gains to offset any ordinary income. Also, as a warning, watch out for the wash rule. This rule prevents taxpayers from repurchasing the same or substantially similar security within 30 days of selling at a loss. If you have any questions on loss or gains harvesting, call us. We'd be happy to visit with you, or you can talk to your tax professional. Tax gain harvesting means taking capital gains in the current tax year. On the surface, it might appear that the taxpayer should always harvest capital gains because of higher tax rates. However, harvesting gains introduces a trade-off between lower tax rates versus the loss of a tax deferral. Remember, when taking a gain for the tax purposes, although the tax is paid at a lower rate, it is paid sooner. In a few minutes, we're going to talk about some tax policy proposals, but this is timely. So let's look at one of former Vice President Joe Biden's tax proposal that is about capital gains rates. The proposal is to eliminate the preferential rate of long-term capital gains and qualified dividends on income over $1 million. This is a significant proposal and the fundamental shift because capital gains rates have never been eliminated for any taxpayer. This proposal is for those affected basically an increase from 20 to 39.6%. If it looks like it could be enacted, then at today's lower rates, some people might consider selling some assets. So let's look and see how this works. Old 2017 rules had 3 rates for long-term capital gains and qualified dividends. In 2020, we still have the same 3 capital rates for long-term capital gains and dividends. However, in 2022, if things change, this could bring rates for long-term capital gains and dividends up to 4 individual rates. Therefore, we need to continue to follow tax laws and changes and any proposals moving forward. Remember, to review your year-end retirement contribution plannings. Here are some of the contributions plan maximums that could be applicable if you're participating in one of these plans. Another critical area to review before year's end because of the Secure Act is what we refer to as the overall family tax bracket management. Logically speaking, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take the distributions after your passing so that the tax bracket is much lower. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take a distribution in your tax bracket before you pass, then convert those assets to Roth IRAs and leave your beneficiaries an account at a much, much lower tax bracket. You still have to take out the money over the course of 10 years, but you can grow it tax-free. An annual step up is considered to review your marginal tax bracket and your beneficiary's marginal tax bracket each year. Some benefits from Roth IRA conversions include they can lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no required minimum distribution at age 70.5 and 72. Roth IRAs allow tax-free withdrawals for beneficiary. So something else to consider. Let's talk about some qualified tuition plans for kids. Qualified tuition plans, also named 529s, are a great way to tax efficiently plan for the financial burden of paying for tuition for your children or grandchildren. Originally, earnings in a 529 plan could be withdrawn tax-free only when used for qualified higher education at colleges, universities, or other vocational schools. However, the rules changed so that now 529 plans can also be used to pay for tuition at elementary, secondary, public, private, or religious schools up to $10,000 a year. Unlike IRAs, there are no annual contribution limits for 529s. Instead, there are maximum aggregated limits, which vary by plan. Under the federal law, 529 balances cannot exceed the expected cost of the beneficiary's qualified higher education expenses. The 529 plans are limited and may vary by state, ranging from $235,000 up to $529,000. Some states even offer a state tax credit or deduction up to a certain amount. Contributions to a 529 plan are considered to be completed gifts for federal tax purposes. So in 2020, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Anything over the $15,000 must be reported to the IRS on Form 709 and will count against the taxpayer's lifetime estate and gift tax exemption, which is currently sitting at $11.58 million in 2020. There's also an option to make a larger tax-free 529 contribution if the contribution is treated as if it were spread evenly over a period of about 5 years. For example, a $75,000 lump sum contribution to a 529 plan can be applied as though it were paid out over 5 years at $15,000 a year, as long as no other gifts are made to the same beneficiary over the next 5 years. Grandparents sometimes use this 5-year gift tax averaging as an estate planning strategy. If you want to explore using or setting up a 529 plan, it can be confusing. So again, call us. We'd be happy to assist you with that. Let's talk about annual gifting. As we said earlier, when we're talking about 529s, you may also gift up to $15,000 tax-free each year to a donee in 2020. These annual exclusion gifts do not reduce your lifetime gift tax. This annual exclusion gift is doubled to $30,000 per donee for gifts made by married couples. You can also help someone with medical or educational expenses without incurring a gift tax. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expenses must meet the definition of a deductible medical expense. Qualified educational expenses are tuition, books, fees, and related expenses, but not room and board. You can find a detailed qualification in the IRS publication 950 and the instructions from the IRS Form 709 at irs.gov. Let's talk about wealth transfer. Wealth transfer is a planning item to think about, and this exemption amounts for gifts, estate, and generation skipping taxes for 2020 is $11.58 million for a single person and $23.16 million for married couples. Any amounts over that is subject to a federal 40% tax. This high amount provides some of our high net worth clients a significant planning window to make gifts and set up irrevocable trusts. As a reminder, as of now, in 2026, the estate tax exclusion will return to the $5.49 million, which is adjusted for inflation. On November 26, 2019, the Treasury Department and the IRS issued a final regulation under IR 2019-189, confirming that individuals who take advantage of the increased tax or gift exclusion or portability amounts in the effect of 2018 to 2025 will not be adversely impacted when TCJA sunsets in 2026. If you have large estates like some of our clients, please call us to discuss this. We would be happy to visit with you about this and how it will impact you. While the election is in November, Democratic Party nominee Joe Biden has released some possible tax law changes he would like to make if he wins the presidency. While these will be future changes and must be approved by Congress to help you think about planning your future strategy, here are some of the proposed changes that you need to be aware of. If Joe Biden were to become president, he would increase corporate tax rates from 21 to 28%. He would increase the marginal tax rate for the top earners from 37 to 39.6%. His intent is to raise the capital gains tax on filers with incomes above $1 million to 39.6%. He plans on limiting itemized deductions. Biden's tax plan includes a cap on itemized deductions of 28%. This means that for each dollar of itemized tax deductions, including charitable contributions, a taxpayer or couple filing jointly would only receive a maximum benefit of 28%, even if the filer is paying at a higher marginal tax rate. He intends to phase out all small business income deductions of those over $400,000. He plans to eliminate the step-up in basis. The step-up in basis refers to the cost basis of assets or property transferable to an heir upon death. If, as an example, an individual purchased a home for $300,000, but it was worth $600,000 at the time of the death, and today the heir would only pay capital gains for anything over $600,000 if the home were to be sold. If Biden's tax plan proposal were to become law, the heirs would not inherit the step up in cost basis, and they would have to pay taxes on anything over $300,000. There would be a reduction in the estate tax down to $3.5 million immediately. This means estates over that value would be heavily taxed at a federal rate. Obviously, this is all just a proposal, but it could be helpful information as you plan your future tax years, depending upon how the election turns out. In summary, here are some of the items that you should review prior to tax time. First, what's your tax rate? Do you take the standard or itemized deduction for tax planning purposes? Think about your tax gain and loss harvesting. Retirement planning contributions. Have you thought about educational planning opportunities or charitable gift planning, and also estate tax planning opportunities? It's also helpful to think about tax planning for any major financial or life events next year, or also in the future, as well as tax planning for any other personal or situational concerns. Our tax report for the year-end tax planning is available. And as we said when we started, A proactive approach to your tax planning instead of a reactive approach could produce a much better result. If you know of anyone who could benefit from our report or this workshop, please pass it on to them or let us know. We'd be happy to get in touch with them. We love helping others and always consider an introduction to others to be the highest compliment that we receive. Thank you so much for your time. Remember, your health and well-being are our highest priority. Our goal is to help you, and we appreciate the opportunity to assist you with your financial needs. Please call our office whenever you need us.